the Twitterverse. For some reason, Twitter's always first. All right, here we are live now on YouTube. Hey everyone, welcome back to Swan Signal Live. I am your host, Brady Swenson, Head of Education at Swan. We have another fantastic pairing for you today. Really excited to be here with Nic and Lyn. I will introduce them in just a moment, but first I will shill Swan for you for just a moment. Talk to you about what we've built here at Swan. We have built the best way to accumulate Bitcoin with automatic recurring buys. And you can just, it's 1, 2, 3. You set, your bank account, connect your bank account. You set the frequency and amount you want to buy, and we buy it for you. And then you can withdraw it automatically if you'd like as well. So we do that with extremely low fees, up to 57% lower than Cash App and up to 80% lower than Coinbase. Get off Coinbase, get on Swan. And in case you missed it, we're setting up daily buys. It's going to be launching soon. So you can buy every single day, catch those dips a little better even than on the weekly. And you can sign up for that at swanbitcoin.com/daily buys. All right. I am thrilled to welcome Lyn Alden back to the show. She's an investment strategist. Lyn was previously on episode 21 with Jeff Booth. That was has been so far the top Swan Signal episode yet. Lyn, welcome back to the show.
Thanks for having me again.
All right. And Nic Carter, partner at Castle Island Ventures, well known, of course, for his great Bitcoin writing. Excited to have you here, Nic, along with Lyn, for your first appearance.
First time. Thank you. Glad to be here.
Exciting for this one. All right. So let's dive into talking about some news that came up recently. You were on, Lyn, a great episode of Preston Fish's The Investors podcast with Jeff Booth and Luke Grahman. I think it was about 10 days ago. This was after the Microstrategy news, but before Fidelity announced that it is launching a Bitcoin-only fund. Both of these, of course, are on the heels of big macro investors becoming incredibly bullish and revealing positions in Bitcoin. Paul Tudor Jones, Raoul Pal, etc. These are some pretty big dots starting to form a pretty bright line. What's your take on MicroStrategy and the Fidelity announcements?
I think those are important parts of this whole narrative because in each halving cycle, basically Bitcoin reaches a new kind of group of investors, right? So largely up till now, it's been a mostly retail driven, asset class. But in the past couple of years, it's starting to get more institutional access points. So seeing corporations, at least small corporations, begin to diversify into Bitcoin, and seeing some of the big players begin to allocate to it. So there's already been a certain amount of family office participation, a little bit of hedge funds, but seeing kind of bigger names go into that space is definitely very important for the asset class. As we go into this next cycle, and I'm sure Nic can talk more about the Fidelity action. I think that he probably has more to say there.
Well, I haven't been out of Fidelity for a couple of years. I'm not really privy to all the details there. But I will say that Fidelity's commitment to Bitcoin since 2014 has been unquestionable, and they've kept building products relating to Bitcoin that whole time. Although it's a long journey, like any large financial institution, it takes a long time to get full buy-in. But I think to me it's important just to kind of sit back and realize that the financial plumbing in terms of access points to Bitcoin is so superior today as compared with 2017. It's almost incomparable. So there's vehicles like, what appears to be this new Fidelity fund. The CME is a highly liquid venue now. There's a lot of participants that can only really trade those CME futures. It wasn't really liquid or meaningful in 2017. And then you have, really high quality custodial offerings, obviously like the one Fidelity offers, but there's others now as well. These things just fundamentally didn't exist in 2017. So the Bitcoin's market's capacity to absorb new capital from a more diverse set of participants, it has also progressed significantly, which is why I think there's no boundary to where this could go this time.
Yeah, I cited Fidelity's custodian solution in my Bitcoin article from a couple months ago. So this is still just it's not like Fidelity's entering it for the first time. Obviously, it's just they're building on the fact that they were already in the space. So I agree. It's it's a totally different world than it was 3-4 years ago.
It really is. Go ahead, Nic.
I was just going to say, the fund, there's a lot of details around it, but once you have those little pieces built like custody, you can build all sorts of other financial products and asset management products on top of it. And now that we have those puzzle pieces in place, I think we're going to see a lot of different asset managers jump in to the mix. I think we even saw a Bitcoin product release in Austria today on a Viennese stock exchange. You see this kind of gradual development. There was a 3IQ one in Canada recently. You just see more ways to express an opinion on Bitcoin and more jurisdictions emerging all the time. It's just like this steady march of progress.
Yeah, and I would expect that we'll continue to see more news like that, in the coming months and years. And it just feels like it's sort of building. It's like a snowball rolling down the mountain, and it's just kind of exponentially advancing, which is what we would expect from, this network technology built on top of other network technologies using the network effect of money. There's all kinds of exponential, reinforcing going on with Bitcoin. So when we're talking about these financial products like this, Fidelity Fund, the CME futures, et cetera, there's kind of like, I guess, continuing concern among Bitcoiners that, using these kind of tools, rehypothecating Bitcoin or, creating like paper versions of Bitcoin, et cetera, might suppress price or, basic, maybe even bring Bitcoin like under control, sort of like it did with gold. I talked with Preston Pish about this last week on this show, and he had a good answer for it. He said that Bitcoin democratizes final settlement, right? And since final settlement is so much easier with Bitcoin, that risk of rehypothecation and kind of control of the asset is diminished. I would love to hear what you guys have to say. Nick, you want to start?
Yeah, I have a similar answer. You just compare Bitcoin with gold and look at the settlement characteristics. And because it's easy to take physical final delivery of an arbitrary quantity of Bitcoin, if you're concerned about your custodian or bank or, credit provider or broker, you can withdraw your coins. Obviously, if it's in the terms and service that you can never withdraw, then obviously you can't. But at that point, you never really had ownership of actual Bitcoin. You only ever had an IOU. But to any service that allows for withdrawal, if you become the slightest bit concerned, you can opt out of that system. That's different, I would say, from gold. Not to disparage gold, but gold is physically instantiated, and it lends itself to being trapped in these kind of walled gardens where every link in the supply chain, from refiners to custodians to financial institutions, is heavily authenticated, and it's costly to get gold outside of that supply chain. We saw these dislocations between New York gold and London gold earlier this year because you had to physically transport gold on planes, whereas with Bitcoin, that physical final settlement is easier and cheaper. The other thing I would say is that verification is cheaper for Bitcoin. I can prove that a Bitcoin payment I'm receiving is genuinely Bitcoin and that, it's the real thing. The equivalent with gold would be to use, an XRF spectrometer or something like that to verify the atomic properties. I can also, a third party can prove to me that they own a certain quantity of Bitcoin, which is very important. This is why I'm always blathering on about proof of reserves, because a third party can prove that they are, in theory, solvent, or at the very least that they have a quantity of Bitcoin that they claim to have. So that's why I think the custodial environment for Bitcoin is not so concerning to me, because A, we have the ability to hold these custodians more accountable through these cryptographic operations, and B, because if shit hits the fan, basically we can withdraw and take final ownership over our physical Bitcoin effectively.
I agree. And I think so. Some of the people that brought up those concerns, I think, had good basis to be concerned about that, because any asset that has a reasonably high stock to flow ratio is subject to more market manipulation compared to an asset where, most of what's produced is consumed in the same year. So, gold's had this long-standing history where if you look at the paper markets, there's far more paper assets than the underlying gold metal most of the time. So a lot of people think they own gold, except if they were to all try to withdraw their gold at the same time, basically the exchange would cease to function in most of those environments. So, gold's always had that issue, but I think, there's kind of two reasons for Bitcoin to have less of it. One is this issue that it's much easier to authenticate and transport, digitally, and then two, because it's so volatile that it's a much less kind of leveraged area at least for these major exchanges than gold. So a lot of the custodians that allow these more like derivative contracts, they want more underlying Bitcoin exposure than they would for gold, which tends to be far less volatile and a larger asset class.
We have a related question coming in from our Telegram chat. It's at t.me/swan signal if anybody's interested in jumping in there and chatting. We also have quite a few people chatting in the YouTube at youtube.com/swan signal. So this is from Joe Rogers. He says that he's heard speculation from our friend Hass McCook, Bitcoiner, well-known on Bitcoin Twitter, about fractional Bitcoin reserves being an issue that is suppressing price. Also, Nick, you've been a pretty strong advocate for proof of reserves, as you were alluding to earlier. Can you share your overall opinions on if you think exchanges are indeed fractional reserve banking Bitcoin, and what are the long-term implications if so?
The truth is that currently, for a lot of these offshore exchanges, we have no way of knowing whether they're fractional or not. We just have to take them at their word that they're effectively not committing fraud against their depositors. It would be much better if there were self-regulatory forces in the industry where depositors had a habit of using exchanges which did attest to the existence of reserves. So market forces. That would be my kind of ideal situation, whereby users were to, migrate over to custodians that were or exchanges that were more serious about proving the existence of reserves. Barring that, I think what's also possible is that you get a regulatory outcome, which would be kind of adverse, where assuming there's more quadrigas, I'm sure there's other quadrigas lurking out there, especially the offshore exchanges. Assuming there's more quadrigas, regulators could say, like they did in Canada, hey, we're actually going to effectively disallow custodial ownership of Bitcoins at all. And we're going to demand that exchanges issue or brokers issue Bitcoins on a pass-through basis, and that you're not allowed to hold them on behalf of depositors at all, which is kind of a bad outcome. It looks like that's we're going to get in Canada at some point. That'd be a bad outcome because there's always demand for banks. I think that's a reasonable thing to exist, to want, intermediated access to your coins if you don't feel equipped to hold them for yourself. But yes, I'm 100% sure that there's other exchanges which are covertly fractional. It could be due to bugs, could be due to mistakes, accounting errors. From what I've seen, a lot of exchanges don't really have a good apprehension of their balances. Maybe they end up with a bunch of stranded UTXOs that are uneconomical to withdraw, for instance, due to fees. There's a lot of ways that exchanges can kind of tip over into fractional territory.
Lyn, do you have any thoughts on fractional reserve banking in Bitcoin?
Not strongly, because it's not an area that I go into that much depth on. I do, from what I've seen, the offshore ones are more, there's more risk in some of these offshore smaller operations, where there's more leverage, I think. Whereas, if we're talking about kind of more institutional, custodian type situations and futures contracts and things like that, a lot of them have pretty strict requirements. But yeah.
Yeah. Yeah. All right. Well, let's move on then. Thanks for the answer there, and I hope that answered your question, Joe. Let's move on to the Jerome Powell speech. So as usual, the content of the speech was pretty well understood before it happened, but Powell did confirm that the Fed will tolerate inflation over 2% for short periods of time. He said last week we had Andy Edstrom on, like I said, with Preston, and he said that Powell is now the anti-Volcker. But is this really a change in policy or just a small kind of recognition of the reality of an even more expansionist policy that may be required at this point? Lyn, you want to start on that one?
It's kind of a small change in policy. So it's actually really nothing new because they were already telegraphing this ahead of time. So anyone who reads the Fed meeting minutes saw that they were willing to allow for an overshoot of inflation. And even going back all the way to 2018, they've been emphasizing their 2% inflation target as a symmetric target. So they started to slip in the word symmetric more and more. And then in 2020, due to this whole the pandemic, they started to more directly say, well, we want to overshoot it. And then Jackson Hole, he went out and called it average inflation targeting. And the main thing was kind of just more directly saying it and publicizing it at a big venue compared to only sticking in their meeting minutes, which are all to some extent subject to disagreements. Because, for example, some things can show up in the meeting minutes, but not necessarily become official policy because the different participants can discuss and agree and disagree with each other. So for the Fed chair to say it at Jackson Hole was a little bit more of an adamant, outcome. The main thing I think to keep in mind is that the Fed doesn't have a lot of tools to directly create inflation. They've been wanting higher inflation by the way they measure it, which is the PCE, and they haven't reached that target very often. According to the way they measure it. So it's really more of like if you look in historically, it's in this sort of environment where rates hit zero and where the Fed's expanding the monetary base and kind of using tools like that. It's really more about deficit spending that tends to be a somewhat more inflationary outcome. And so the Fed is kind of indicating that they're not going to get in the way of higher inflation, but they're not really the causers of that. They have to kind of it's more about the fiscal authority, how they choose to spend, if they want to give out more stimulus checks, more more unfunded tax cuts, whatever they want to do. They could potentially cause more inflation, and then if that happens, the Fed can just kind of stand by. So we have seen a rebound in inflation expectations from the March low, although currently they're hovering under 2%, for most of the durations. So it's really just kind of a rebound in inflation rather than higher inflation expectations.
Lyn, I wanted to ask you something actually. So many times you've indicated you think we're headed into a more inflationary environment, potentially kind of stagflation even. And the rebuttal I always hear is that kind of demographics are destiny. And, we're going to have just a fundamentally hard time finding inflation and, growth, which I guess is, closely related due to the aging workforce and so on, and those other kind of fundamentally deflationary factors. In light of this, I know it doesn't really change much, but what do you make of the prospects for actually causing inflation in the U.S., especially given like the Japan example, which everyone always talks about?
Sure. Yeah, there's a couple things to unpack there. So definitely demographics play a large role, as does technology, which is what I talked to Jeff Booth about last time. So technology, of course, is a very strong deflationary force. And that's what we saw, in many decades before, including the last time we were in one of these long-term debt cycles, this last kind of period of kind of a rebound in inflation, which started back in the 1930s and 40s. They had a lot of technology come online, they had high debts, and it caused a pretty big disinflationary trend until they intentionally devalued their currency. So all of those trends in practice are very disinflationary. So weaker demographics, more technology, more debt, all of those are disinflationary forces until they cause enough of a breaking point that policymakers use more aggressive tactics to devalue their currency. So back in the 1930s and 40s, for example, first they devalued the dollar versus gold, and then they ran very large deficits and cap yields for treasuries below the inflation rate for about a decade. So the combination of that kind of 1-2 punch devalued currency pretty considerably and devalued debts relative to nominal GDP by extension, even though nominal debts barely came down at all. Like there was like a, maybe 12 to 15% nominal reduction in debt, but debt as a percentage of GDP collapsed considerably. And you can point to some places like, for example, Argentina. They don't have phenomenal demographics, but they have no problem getting inflation, right? Because in extreme cases, those monetary conditions and fiscal conditions can override demographics issues or technology-based issues. And Japan is kind of a unique situation because they are the world's largest creditor nation. Which means that they own more foreign assets, than foreigners own of their assets by a wide margin. And so they've kind of had this massive savings glut. So even though they have high debt, sovereign debt relative to GDP, a lot of that debt is held internally, and then they also hold a ton of foreign assets. And so as a result, and they also they run positive trade balances, positive roughly balanced trade balance, but then positive current account balance. So they kind of have more money flowing into their economy than out every year, and so that tends to be kind of supportive for a currency. Whereas the U.S. is kind of the opposite situation. We're the world's largest debtor nation, so we've due to running persistent trade deficits and current account deficits over the past several decades, we've developed a deeply negative, net international investment position. So we're somewhat more vulnerable to a cycle trend in inflation. And so my primary outlook is to kind of see these large monetized deficits eventually kind of spur higher inflation. Now, I think that can take a lot of forms. So, for example, I see people, calling for like hyperinflation by the end of the year or next year, like that. That's not the kind of approach I'm looking at. It's more like a trend change from ever lower, disinflation to, kind of a bottoming process and then a potential rise in that trend towards a more inflationary situation.
So mindful of this, I mean, what is the metric for inflation that you pay attention to? I mean, a lot of people would say that asset prices reflect inflation. Is it like the dollar index? Is it CPI? Like, what is the purest metric for actually measuring this?
A couple different ways. I look at CPI, I look at PCE, things like that. Those kind of understate it. Asset prices are definitely a big thing. That's been more over the past decade because we've had the monetary base expansion, but not really aggressive fiscal spending to really get that into the real economy. So it all concentrated towards the top and got into asset prices. I also look at, for example, precious metals, gold in particular, because it's a large asset class. So it doesn't move a ton on its own, other than some of these more inflationary expectations or in response to real yields. So I like to look at things like the S&P 500 as priced in gold, or just the nominal price movement of gold. Things like that. In addition, I also look at the expansion of broad money supply itself. So historically, the year-over-year change in M2, broad money supply, has gone with inflation, but tends to be higher than inflation, right? Because we also get the other disinflationary forces of better technology, better productivity, things like that. But historically, some of the big spikes in broad money supply have eventually led to higher inflation levels. So I kind of look at a variety of different metrics to kind of measure that over time. And then the main metric I look at to kind of precede inflation is deficit spending by the fiscal authority, because that's what historically tends to drive, kind of a deal with a long-term debt cycle and then bring a more disinflationary shift into a more inflationary shift.
So let's talk a little bit about those fiscal authorities. We have a big election coming up. I know that that's something that macro investors and strategists need to pay attention to. Do you think, Lyn, that we're going to see any difference in terms of like economically speaking and fiscally speaking? And then, of course, as it relates to inflation, potential inflation, CPI, and assets, whatever, between the two possible outcomes of this election?
Yeah, I think you can get different outcomes. Obviously, there's different types of spending they want to do. One thing I've been emphasizing is there's more than two outcomes, right? Because there's also in terms of who wins, that's obviously the big binary choice, right? Which president is here next year, but it's also if the Congress is gridlocked with that president or not. So, for example, you could get a Biden victory, but then the Senate could stay red, for example. Right. And then we're more in a situation like we saw in for example, Obama's second term, where there actually wasn't a lot of fiscal spending because we were more in gridlock. Whereas if you get a Trump win and the Senate stays red and you have a pretty strong kind of red sweep, right? Then Trump's a very spendy president, either in the form of spending or in the form of unfunded tax cuts, for example. On the other hand, if you get a blue sweep, you're also likely to see a pretty good amount of spending. And Biden would probably spend more, but also could potentially raise taxes more. So it's unclear whether the deficit would be bigger in either of those scenarios. I think one of the potentials for a more disinflationary period would be to see, for example, like I said, a Biden win and a Senate red hold, and then you have gridlock, and then probably less of both things. So even kind of, I think the long-term trend I'm tracking is a probable shift from a disinflationary trend to a more inflationary trend. But ever since we kind of run off this fiscal cliff at the end of July, right? So ever since the PPP loans were not really happening, and ever since the extra unemployment benefits stopped going out, and the stimulus checks are long since spent, I've been saying, okay, we had this big reflationary rebound, but now they're back in gridlock. So we have to see what happens over the next couple months to see if we're probably, it might take something like either more civil unrest or another big asset price decline to spur policymakers to do something. Because as long as stock markets, as long as stocks only go up, as long as Tesla's going up, as long as stock splits can make, the stock prices soar, and there's not kind of a ton of protesting and things like that, they don't really have a strong incentive to do another, big fiscal boost.
Nick, have you been thinking about this at all?
Yeah, and I think Lyn covered it well there. What I would say is I've noticed that the conservatives are not a party of fiscal responsibility anymore. That time seems to have long since gone. And both parties seem united on their desire to spend excessively and grow the size of government fundamentally. I haven't really noticed much of a difference between the two of them. The only difference is the kind of, I guess, spending programs that they would pursue. Although there's certainly some commonalities, but it seems to me that there's a political demand in this country, or growing political demand or normalization of kind of unfettered handouts in the form of either tax cuts or UBI-like programs. These have been kind of normalized in the last 18 months. They were unconscionable, 2 years ago. Yang kind of brought them into the conversation, and now it's effectively mainstreamed. The notion of kind of semi-permanent governance stimulus directly to individuals. And I think that's notable because that's kind of, I call it high velocity issuance, because that's directly into the actual economy, especially if that's going right to households, as opposed to QE, which it has kind of a hard time making it into the real economy, so to speak. So I think regardless, we're going to get significant spending. And, my view of this is that that's fine. Like, some amount of spending is appropriate, but the government is not the best allocator of funds. I think the free market does a better job at that. So I never see this questioned or scrutinized, the notion that the government should be the primary allocator of capital in the economy, especially as the government spending share of GDP grows from kind of 35%, where it normally is, to north of 50%, where it effectively is today.
So I want to turn to talking about Bitcoin as collateral. Raoul Pal posted yesterday a couple screenshots from his monthly GMI reports newsletter that is going out to subscribers. He discussed Bitcoin collateral in it, and he called Bitcoin pristine collateral. He described how the debasement of collateral has created this environment where he said the tail risk of really bad outcomes are much fatter than we are comfortable with. And then he continued to say that all we need to get Bitcoin from where it is now as a form of collateral to the future of collateral for a global economy is that it can produce a yield curve. Lyn, I thought, I heard the term yield curve and I thought of you. Can you talk to us about what you think Raoul is saying here, and what the idea of, like, how could Bitcoin produce a yield curve now or in the future?
I didn't look into his tweet in specific, so I don't want to talk for him. I do think I'm mostly approaching Bitcoin similar to gold at the current time, but as a smaller, kind of a smaller, growthier version of it, right? So, whereas treasuries, for example, historically pay you a yield, but they have counterparty risk, and they're not, most of them are not inflation adjusted, and even the ones that are inflation adjusted are adjusted to the government's definition of inflation. Whereas gold and Bitcoin and some other commodities are scarce, yieldless assets, right? So in an environment, historically, if you look at gold's historic price performance compared to treasuries, for example, gold, people often think of it as an inflation hedge, but it's really a negative real yield hedge, So gold's year-over-year price change tends to inversely correlate to real treasury yields or real bank account yields. So if you can put cash in a bank, and say inflation's low, it's 2%, and you can get 4% from your bank, your treasury, you're making a positive 2% real yield. So there's a strong incentive to save in that way, to save in fiat, and it puts kind of a higher opportunity cost on things like gold that are yieldless but kind of scarce inflation adjusted asset. On the other hand, when you have periods where real yields are negative, those yieldless assets suddenly become a lot more attractive because they're scarce, but they have no counterparty risk and they can't be inflated away. And the whole opportunity cost for them either goes away or even becomes negative. If a zero yield is better than what you're getting from a real treasury yield, suddenly there's an opportunity cost to holding treasuries instead of holding gold or silver or Bitcoin and things like that. So I'm focusing less on the yield itself. And I think over time, if Bitcoin becomes a larger asset class, just like there used to be monetary systems built on gold as an asset class, you could conceivably have more and more monetary systems built on Bitcoin. And of course, we already see that in the form of some of these ways to get yield from it, which is basically like operating like a bank. To my knowledge, currently not FDIC insured or anything like that. So there's more kind of nominal risk there. But yeah, as things build out, you can get more systems built on top of that underlying collateral.
Mm-hmm.
Yeah, I'll just add to that. So there is a vibrant credit market that exists on Bitcoin already. It's because there are entities that seek to borrow in Bitcoin terms, and their actual revenues are denominated in Bitcoin terms too. So it makes sense. It kind of stands to reason they would have Bitcoin denominated financing requirements. We also see this with Ethereum. I know I'm not supposed to mention that on here, or stable coins. There's a very vibrant kind of stablecoin lending market. We're talking about entities that they want to obtain capital efficiency denominated in stablecoins. They don't want to exit the crypto ecosystem. They want to stay on crypto financial infrastructure. So they want to borrow in kind. With Bitcoin, big borrowers would be miners, for instance, who receive their payouts in Bitcoin, obviously from the protocol, or entities that are performing the GBD arbitrage. I know that's kind of a shorter term play that's maybe not going to be around forever. But there's certainly credit that exists on top of Bitcoin. Obviously, that's not risk-free. I don't think there really is anything such as a risk-free rate. I think that's kind of a misnomer anyway. Generally speaking, the whole point of Bitcoin is that it's a liability-free asset. It's no one's liability, just like gold. So it shouldn't deterministically come with a yield. That yield has to be produced by operationalizing it and conducting underwriting like any of these lenders do, for instance. But it just so happens that the Bitcoin kind of credit market is so vibrant right now that those yields on Bitcoin at most of the larger lenders are, kind of 6 to 9%, which is kind of confusing to some people, given that that's so structurally high. But I would say that's because we have a kind of a trapped little silo here that's not that well integrated into the rest of the financial system. So Bitcoin flavored loans is still a very attractive thing. That's why borrowers are willing to kind of pay richly for that.
So Raul will continue, and you can mention Ethereum on this podcast, on this show, Nick. It's okay. In fact, I have a question for you that will mention Ethereum in just a minute. So Raul then stated, and I know you may not have read this yet, it just came out yesterday, and that's fine if you guys want to pass on this. But he went on to say that the revolution in DeFi is doing just that. It's establishing a forward curve of future value. And he said that it will establish the time preference for Bitcoin over 30 years or more. And he's talking about establishing like a long-term yield curve like you would with treasuries. So Nick, does that make sense to you? DeFi on Bitcoin and using basically, like you're talking about, kind of financialized products on top of Bitcoin to produce what we can evaluate as the time preference for Bitcoin over a 30-year period.
Yeah, and I enjoyed, was it Nick Baccia's comments, his writing on how Lightning could be the source of an interest rate for Bitcoin. You can certainly see how that would come to pass. DeFi on Bitcoin, I mean, I wouldn't even call it DeFi necessarily, but yeah, the the instrumentalization of Bitcoin as collateral, which is maybe like a more precise way of describing DeFi, that has always made a lot of sense to me, and it's very compelling to me. We're already seeing it. It's much more convenient for lots of Bitcoiners to take out dollar loans against Bitcoin that they held for tax efficiency purposes, just pure convenience purposes. This is a vibrant segment already. It totally makes sense. Moving forward, I would expect to see that being formalized as the creation of stablecoins on top of Bitcoin collateral, which would be effectively a way to porting over the MicroDAI system to Bitcoin. I'm sure that can be done. There's kind of a number of different sort of technological paths to doing that. I don't think it's impossible. I think it's actually possible with current Bitcoin script potentially. Definitely if we include some of Jeremy Rubin's stuff with covenants. But yeah, I think instrumentalizing Bitcoin as the base asset in this system and understanding that the base layer is more intended and it's more suited for settlement as opposed to inserting every single payment onto that base layer, that makes sense. And part of that is also Bitcoin banking. Bitcoin banking is effectively a way of creating that layered model. And I would look back to the free banking era where gold was the kind of base, liability free collateral used for reserves by those free banks. And they issued notes against that gold. This is something that Hal Finney talked about in 2010. I'd love to see more development in that domain, whereby you have exchanges issuing notes against Bitcoin held on deposit, potentially mutually accepting each other's notes, creating a vibrant system like that. I think that is a vector scalability that's kind of underexplored so far.
That's essentially how I'm viewing it. So yeah, if you look back, a century ago, you had gold as an underlying settlement asset, and then you had, dollars and other currencies kind of based on gold, and entities could deposit them, lend them, get a yield on them, right? Because it's money built on top of that settlement asset in a more convenient package and in a more kind of debt-based system. Whereas the underlying asset is the the key collateral. And even today, I mean, it's less common, but for example, India they released some gold bonds, right? So India as a country, their borrowing rate is pretty high, even for the sovereign, because the currency is historically not very good at holding its value. So they introduced some gold-backed bonds where you get a lower yield than their fiat bonds, but it's payable, I believe in either gold or you can take the fiat. And so that's kind of their way of saying, it's basically collateralizing a loan. It's saying, there's more substance to that borrowing in exchange for a lower yield. And from the perspective of the buyer of that bond, it's a way to get yield on gold exposure, but by taking counterparty risk. So you're taking some degree of counterparty risk. It's not super high because it's a sovereign, but you're taking some counterparty risk and you're getting yield for that. And so we're starting to kind of see in an accelerated way Bitcoin, do some of the same things that we saw gold do over the centuries, which is, become an underlying settlement asset, and then to see more and more systems built on top of it.
That's great. All right, so here's the Ethereum question for you, Nick. Well, we're gonna get it. This is gonna lead into it. So this is from Nate on Telegram, and he wonders, are there any specific use cases for crypto dollars, which is your term to describe Tether and GUSD, et cetera, that have surprised you as you've been researching its growth?
I don't know about surprise necessarily. The pace of adoption for crypto dollars has certainly surprised me, even though I was probably among the more optimistic kind of watchers in terms of its growth. I mean, exploding from 4.5 billion at the start of this year to 16 billion today in the monetary base of crypto dollars is just preposterous growth. It's insane. And the use cases, as we understand them, that you can kind of put the puzzle pieces together. A lot of it has to do with evading capital controls in China, for better or for worse. Maybe a lot of people don't like that reality or wish that it was something more innocuous, perhaps. But there's a huge wealth outflow right now. Those capital controls are a barrier to commerce, and people are naturally routing around them. And it seems like Tether is actually the favored vehicle for doing that. Now, whether that can be sustained indefinitely is unknown to me. I don't know if that's possible. I think I'd like to see more usage of crypto dollars kind of in a closed loop context instead of just inter-exchange settlement or as a way to hold collateral to interact with crypto exchanges. But yeah, there's a plethora of uses out there. I think the most interesting one is definitely the dollarization events that we're seeing in Latin America, in particular Venezuela, where crypto dollars are relevant today. Just recently, Juan Guaido, the kind of president in exile, took ownership of something like $18 million worth of funds that were seized by the treasury that were seized from the Maduro regime and distributed them or began a program of distributing them back to Venezuelan nurses and doctors through AirTM, which is a kind of a crypto application. So we're seeing this relevance, this digital dollarization happening in places like Venezuela right now. A lot of that is Bitcoin kind of focused. I mean, it relies on the kind of Bitcoin infrastructure that's been built there through local Bitcoin. So I think it's pretty synergistic with Bitcoin too.
Do you think that Bitcoin specifically has a use case or like ability to create crypto dollars on top of Bitcoin, or is that just like a use case that is completely separate from Bitcoin to avoid, Bitcoin's volatility for the time being?
I think there will certainly be ways to do that. It's just a question of exploring them. I know some Bitcoiners, dismiss DAI, but I think DAI is the most interesting one of all the crypto dollars there because it's aligned in that DAIs are ultimately backed for the most part by Ethereum collateral. That would be an interesting model to replicate on Bitcoin with those dollar denominated liabilities ultimately causing reservation demand for Bitcoin. So I think we actually have something to learn from that system for sure.
Nice. Okay, one more Ethereum-based question, then we're going to move on. You tweeted earlier today that Ethereum fees at all-time high. It's worth revisiting an article that you wrote a while back. The TLDR being fee-bearing blockchains optimized ruthlessly for the most economically dense transactions at the exclusion of all else. So let's talk a little bit about this idea. And Lyn, I'd love to hear your thoughts on this as well. We'll let Nic start, but maybe we can talk about this idea of ruthlessly optimizing for economically dense transactions, and then kind of segue into your latest piece about threats to Bitcoin's fixed supply.
Yeah, so I'll lay out the idea first of all. So it's a very simple idea. Effectively, if block space is capped, and it effectively has to be, in my opinion, because there's a limit to the kind of computational power that's available on commodity hardware, and there's a limit to bandwidth, there's a limit to storage. All these three bottlenecks mean that node operation, which is single threaded, that you can only, there's a maximum size to any node. There's a maximum size to the bandwidth that everyone in that network can consume and the resources that they can consume. So because of that kind of physical thermodynamic reality, there's only so much space available for transactions. And the emergent consequence of all that is that the most ethically consequential, the largest, typically, transactions are the ones that win that access to block space, force out smaller and more frivolous transactions. And this isn't really a problem in Bitcoin. We kind of saw it happen. A lot of those more frivolous use cases got forced out as fees rose. But now with Ethereum fees rising too, there's some of these Ethereum narratives being punctured a little bit about using it for arbitrary uses. And instead, it's more financial uses that are winning out on Ethereum, especially settling large amounts of value, in particular stable coins. So that's kind of an interesting outcome that's happening. And I guess the pushback you could say is that, well, Ethereum is going to be able to generate a lot more block space, kind of TBD on that, we'll see. In its current form, it's pricing out all other marginal kind of non-financial use cases. And it's only the largest transactions that are actually winning space in the ledger right now, which is a pretty interesting phenomenon to witness.
Lyn, what do you think about the I mean, have you thought much about like the fee market, the blockchain, the potential for Bitcoin in the future to become like more insecure because of a dying fee market, right? There's no subsidy anymore coming in from the blocks, block reward to miners, and perhaps Bitcoin wouldn't be able to sustain security based on fees alone. Does that frighten you at all, or is an attack vector that you've considered viable?
Something I've considered, back in 2017 when I was examining the protocol, and I didn't invest at the time. It was towards the end of that big, the previous halving cycle, the big run up in 2017. I was watching that whole debate about block size and things like that, and especially as someone who's not I'm a more macro focused person rather than I'm not a Bitcoin or a crypto focused person. And so I was just kind of watching that, and it kind of came down to whether or not Bitcoin is intended as a medium of exchange first and foremost, or more of a store of value first and foremost. And it seems, my investment case in Bitcoin is more about the store of value. So I perceive it more as like a digital gold, as a long-term settlement asset, as a way to store something in scarcity. And I would welcome any sort of more efficient systems built on top of that, secure and efficient ways to break that apart. I agree with Nick that just looking at the math of it, obviously less detailed than him, but essentially that the way it works is that if you have a finite space, you have to prioritize the largest transactions as you shift more and more towards a fee-based system, because the fees become larger, but that becomes less consequential if the transaction is very large. And there's always it's one of the inherent risks of Bitcoin as you shift towards a more fee-based model. You could have, for example, seen a version of Bitcoin that has all the same identity, but say instead of a hard 21 million cap, you could have had something that still increases by a small fixed rate every year. And in that sense, the block subsidy stays there, and there's a very tiny low inflation rate, and that kind of pays for the ongoing security of the network, right? So that is one option they could have gone with. But of course, that takes away from the story of absolute scarcity and things like that, even though I personally would still invest in a network like that, because at least the scarcity is still known, right? So even if it's not a hard cap, if it's a very slow increasing cap, what you're basically doing would be you'd be taking, basically in the feed model, you're kind of taxing the people that are using it to transact, and you're not really taxing people that are using it to store long term. Whereas if you have that kind of built-in small inflation, you'd be kind of chipping away at both the people using it for storage and for transacting. And that's kind of a design choice, and it could have gone either way, and it went one way in particular. So I think as we go down this route, as the the halving cycles continue, we are going to look more and more toward transactions. And I think it's something to watch, something to see how the protocol develops, how security develops around that. I think it's a risk to be aware of. I think it's still early, pretty much in that process. But I think that Nick's approach makes sense, which is that as that develops over time, it's going to prioritize bigger transactions and increase the importance of these other types of networks that are on top of it.
Yeah, Nick, you have a good kind of visualization or metaphor for thinking about blocks in Bitcoin. I know we have a lot of new users or new Bitcoiners, new coiners that listen to this show and watch this show. Could you kind of describe or give us the metaphor about how, I think it's the tanker ship metaphor. It's like what I like to call it. That's yours, right?
Oh yeah, is that the one with individual transactions being like bundles of many transactions?
Yeah, right.
That's pretty much the metaphor. Yeah. So the important thing to understand is that a Bitcoin transaction can include many payments, and that there's a fixed overhead in every single transaction. But through mechanisms like batching, you can reduce that fixed cost for many payments. And people don't know that a single Bitcoin transaction can include 3,000 outputs, for instance, and obviously an arbitrary amount of value. So I think the challenge of the big consumers of block space is to engage in those efficiency gaining measures, which actually, to their credit, Coinbase finally did this after about 2 years of demurring. I wrote an article 2 years ago saying, Coinbase, why aren't you batching? You should do it. And then 2 weeks ago, I think they said, hey, we're batching now. So that fee pressure, it does have the interesting externality of punishing the entities that use the blockchain that aren't using it efficiently. So it relentlessly forces optimization from those end users of the blockchain, which is another really nice externality of the fees. It forces you to engage in these space saving measures.
Yeah. I've always thought that image has always stuck out in my mind is thinking about Bitcoin as sort of like a tanker ship, and the blocks is these little like containers on the ship, and not as these little tiny transactions for coffee and stuff. It's like these giant international settlement transactions. Yeah.
And the point is really like, if you look at Bitcoin analogs, we're talking about Fedwire or the interbank clearinghouse systems. We're not talking about Venmo necessarily or PayPal. We're talking, because those are systems that are built on top of these other clearinghouses and settlement networks. Bitcoin is the settlement network. Bitcoin isn't necessarily the payment system. You could, in theory, go about your day making all your transactions with bank wires. You could do that. There'd be a $10 fee. I sent a bank wire yesterday. I had to get on the phone to my bank for 45 minutes, and there's a $10 fee. And it's going to take 2 days to settle or whatever. So you could do that. The same way that you could use Bitcoin base layer for all of your everyday quotidian payments. But ultimately, I think that's not the way it's going to go. I think there's going to be other systems built on top of Bitcoin. Bitcoin will kind of fulfill its destiny as a settlement network.
Yeah. All right. So on your podcast, Nic, you had Lyn on, maybe it was a couple of months ago or 6 weeks ago or so, on the Brink podcast. It's Nic's podcast. Castle Island Ventures produces it. And you guys started talking about the financialization of our global economy and then kind of moved on to something else. But I'd like to dive more into it. So, Lyn, can you give us kind of a rundown of the history of the financialization of the economy over the past few decades and what role the fiat standard has played in that process?
You mean as it pertains to kind of the global reserve status or the more domestic focus?
Both, but yeah, I think start with like the global reserve aspect.
Sure. So it's two interesting points that I find often discussed in media is the way that the global reserve status works. So one is the idea that there's always a global reserve currency, kind of like the one we have now. So the one now is actually against what the media often describes. The one that's been in place since the early 70s is actually very unique. So in prior kind of historical periods, precious metals were, especially gold, was the underlying settlement asset. And then you had some paper currencies that for a time were broadly accepted because those countries had the most the biggest navies. They went around the world. They did the most trade, and so they were recognized currencies that were accepted in many places. But of course, as the world got smaller, so as we got more interconnected, and of course, the big climax of World War II, that's when the dollar took the role as the global reserve currency. And at the time, it was backed by gold, and other currencies backed themselves to the dollar. So you had this big fixed exchange system, and then that all broke in 1971. And then in the early 70s, after that, they kind of redeveloped it as the petrodollar system. So it's the idea that most oil around the world is priced in dollars, and most other commodities as well. So even if France buys oil from Saudi Arabia, they pay in dollars, even though the dollar is neither of their underlying currencies. And so that's kind of forced the dollar as a global reserve currency in a way that previous global reserve currencies never had. So no previous global reserve currency had a worldwide lock on commodities. That pretty much all commodity pricing worldwide happens in that currency. So that's kind of a unique thing about this period, which is starting to cause some problems. The second thing is the idea that if the dollar in any way loses currency reserve status, that it means that another currency has to come along, another fiat currency has to come along and take it. So one of the if you say like the dollar might the reserve status might change a little bit, the first question is like, well, who's going to replace it? Is it going to be the euro? Like, is it going to be the Chinese currency? Of course not, right? So how can those? They're not better than the dollar. So the kind of answer to that approach is that after World War II, because Europe and Japan were so devastated and emerging markets were so small, the United States was nearly 40% of global GDP. So they had a big enough money supply and could do enough commodity consumption and could run big trade deficits, and they could basically supply the world with this currency that they now have a hard lock over. But over time, as Europe, developed back up, and as Japan developed back up, and as emerging markets grew, especially China, United States percent of global GDP shrank. And so now it's in the ballpark of 20%, or even less if you look at purchasing power parity. And the United States is no longer the world's largest commodity importer. That's China. So we're kind of at a situation now where there's no individual country or currency that's large enough to be the global reserve currency. There's no money supply for a specific country that is big enough and running big enough trade deficits and doing all these things that there's enough of it around that only that currency can be used for oil pricing. And so over time, we've seen slow chipping away at the dollar's lock. So for example, since the euro was created over the past 20 years, we've seen the dollar's percentage in currency reserves decline from about 70% to about 60% worldwide. And if you actually include gold, that's gone down even more. So gold's taken a stronger role, especially in the past 5, 6, 7 years. And if you look at even just the last couple of years, if you look at, for example, China's trade with Russia. So more than 2 years ago, that was almost entirely dollar based. But over the past 2 years, especially in 2018 and to some extent 2019, they de-dollarized a lot of that. So a lot of that is now euro based, even though neither of them, euro is not really their primary currency, but they've diversified their currency exposure in their trade, which, because it's Russia, most likely involves energy. So we're starting to see kind of things like that play out, where we're most likely headed towards a more multipolar currency world rather than one currency having a lock on like all global commodity pricing. That's kind of been the trend that I've been following to some extent.
Yeah, Nick, anything to flesh out there in the history of international financialization? And then I want to come back to talking about the domestic finance industry too, and some of the things that have happened and derivatives on derivatives, et cetera.
Well, Lyn is obviously the expert there, and I learn a huge amount from her commentary as well. But I would say that as we see this multipolar world emerging, there's going to be plenty of room for credibly neutral settlement assets. The same way that when you had the international maritime trade system that developed initially, the units that were the unit of account for that trade was gold and silver, as opposed to any other more local kind of commodities or IOUs or credit instruments or anything like that, because there's a liability free. The same thing with digital commodities like Bitcoin. Those make for great neutral assets to conduct commerce in. I'm not saying that's, it's destined to be the global reserve currency or anything like that, but it's certainly, it's great that it exists as a suitable alternative, as potentially this kind of New York-based dollar clearing system loses some of its influence. Maybe as alternatives to SWIFT emerge as the world just gets more fragmented and international finance becomes slightly more difficult.
Yeah. I agree to what particularly his point about kind of a neutral asset being, pretty important in that system. So for example, over the past 5, 6 years, as we've seen, foreign central banks have not really continued their accumulation of treasuries, right? So we've seen a flatlining of treasuries. We've seen an uptick in their gold purchases, right? So we've seen, especially the last couple of years, we've seen 50-year highs in central bank gold purchases. And then if you sort it by, which countries are most aggressively de-dollarizing, right? So Russia's near the top. And over the past 5, 10 years, they've been buying gold hand over fist. So they're not loading up on tons of euros. They're not loading up on tons of yuan, right? They're relying heavily on gold as their kind of settlement asset. So in that sense, currencies in that sort of multipolar world shift a little bit more towards medium of exchange rather than as stores of value, which is essentially the system you saw before the petrodollar system, where it was really gold that was the global reserve currency, with the dollar kind of being the more convenient layer onto that, and then other currencies were layered onto the dollar. And then before then, you had other global reserve currencies that were backed by gold, and they were accepted because of their association with gold. So going forward, it definitely increases the importance of whether it's gold or whether it's other neutral, kind of counterparty-free, scarce assets that kind of can underlie that system more so than having one currency, kind of the one ring to rule them all sort of situation, right? There's no one ring, there's a bunch of rings, and they have to negotiate between themselves what they're going to accept as either, recognizing each other's credit worthiness, or what they're going to use as a medium of exchange.
Great. All right, let's do a quick one on the domestic question here. So the American financial industry has developed. I want to know, like, how has the fiat standard enabled that, or interacted with that development in any way, and how would the finance industry look different on a Bitcoin standard?
Well, there's a couple different layers to that question. So, a theme that I've been pointing out over the past couple of years is the long-term debt cycle, which is phrasing that Ray Dalio of Bridgewater uses, which is, over a 5 to 10 year business cycle, the domestic economy accumulates debt as a percentage of GDP, and then some sort of, it becomes increasingly fragile and leveraged, and then some sort of catalyst happens. Whether sometimes it comes out of nowhere, sometimes it's just an asset bubble collapses. Other times there's some external catalyst like a pandemic or something, and then that forces an economic slowdown, which then enforces a period of deleveraging, which can then further the economic slowdown until the system kind of resolves itself and starts building up from there. The problem, though, is that in every one of those cycles, as interest rates get lower and lower, it encourages more and more debt accumulation. So every cycle ends up with a higher level of debt than the previous cycle. So you only deleverage half the way, you build up from there, you hit new highs, then you deleverage half the way again, and you keep building up. And then what happens eventually is interest rates hit zero, so you hit the zero bound. And historically, that tends to happen. If you go back in history, the last time that happened was the 1930s, right? So it's Ray Dalio often likes to refer to the 80-year long-term debt cycle, but of course the exact time frame can vary. And as if you look back in previous, you can track those debt bubbles all the way back for centuries, but they tend to be smaller because the economies are less financialized. They have less complicated or sophisticated investments and vehicles that can allow for that level of debt accumulation. But when you have a very kind of interconnected, very fast, very kind of financialized economy, they can build up much higher debt levels. But that means that when you start to unwind that, it can be a lot more painful. So each debt bubble, so in addition to each short-term debt cycle kind of building on the previous one, each one of these long-term debt cycles tends to hit a higher peak than the one from nearly a century ago. And that's kind of where we are now, where there's, I can chart in kind of 30 different ways how the 1930s and 1940s have a lot of similarities so far to the 2010s and the 2020s, kind of directly each one or the other. So, as you go forward, I think we're seeing a gradual definancialization probably happening, but a lot of that can depend on policy, and a lot of that can depend on kind of the details of how this plays out. But definitely that current cycle is now pressured.
And if we were to an economy on a Bitcoin standard, how would that be different? I mean, would we be able to would it be, as we were talking about earlier, it would be more difficult to rehypothecate and create derivatives based on Bitcoin because it is so easily settled. Final settlement is democratized, if we want to put it that way. So could a financial industry like the one we currently have even exist on a Bitcoin denominated world?
Probably not to the same level of debt. So for example, one of the complicated things about gold standards, right, is that in theory, a gold standard should restrict spending and should kind of lead to more financially prudent decisions. But what happens in practice is that they build up debt anyway, and then they have to depeg from gold in order to resolve that. So you basically build up such a big debt burden, and it starts kind of all unraveling like a Jenga tower, and then they depeg it. And then so even though gold didn't fail, the gold peg ended up failing. And so that's kind of been the historical case with kind of a gold peg or trying to have non-fiat currency, that it still doesn't fix human nature. Essentially, it just kind of grounds human nature, but it doesn't kind of stop that process from happening. Now, a Bitcoin standard, sure, it definitely opens up new kind of approaches to try to solidify that. So you can authenticate reserves, to use Nick's point. For example, we know how much the United States, for example, claims to have in gold reserves, but do we know how much gold they have? Same thing with China. They claim to have a certain amount. A lot of people think they have far more. We don't know. No one really knows. We just see what they say they have. Same with a lot of countries in Europe. They have a certain amount of gold that they claim they have. Bitcoin can authenticate that more if you had kind of that newer technology instead. And there's also how quickly it can settle, things like that. It all really comes down to how many layers you want to build on top of something, and how kind of easily people trust those layers, and then what kind of fiscal monetary policy are happening so that people are more inclined or less inclined to trust those various layers.
Sure. Nick, there's a lot there to chew on. Do you have any reactions you wanted to share here?
Yeah, I really like Lyn's point that you can't change human nature. And the whole notion of a standard is one where you peg a currency to a monetary commodity. But there's still need doing that pegging and maintaining the peg. And in some cases, discretionarily depegging. And we see this time and again with democracies. The scope of what that state is expected to do generally grows over time, and then you end up with a reckoning over time as those entitlements kind of come due. That seems like it's kind of an intrinsic problem. I don't even know if the monetary commodity at the base of the system, I don't know if that can actually solve the problem. But the beauty of Bitcoin is that it allows us to decouple our finances from the state's purview. And if the state is illegitimate or in the process of failing, we can exit that state, at least in a financial sense. Although then obviously you have to complete the exit in all the other contexts in which you exist in that state. But to me, that's the important thing, is that it gives you that discretion to exit in extenuating circumstances. And we are literally seeing, the crypto industry being used to evade capital controls for asylum seekers, for people that are fleeing states, have no legitimacy, that have no credibility. I'm hoping that won't be the case in the US. I would love for the US to kind of regain its authority. But the important thing is that we do have a state independent monetary commodity, which is highly portable, which individuals can use to potentially opt out and maybe create, smaller or more novel political units. And so, I'm not optimistic about the US adopting a Bitcoin standard or any such mechanism. But I am optimistic about individuals being empowered relative to the Leviathan, so to speak, relative to the state, and potentially being able to exit if they need to.
That's how I view it. And so a couple points there. If you look back in U.S. history, after the previous big long-term debt cycle, the big high debt to GDP period in the 1930s, there was a nearly 40-year period where if you bought and held treasuries, you underperformed inflation, right? So you lost purchasing power by holding government debt or by holding money in a bank account. Not coincidentally, during that almost exact time period was when gold was legal for Americans to own, both in the U.S. and they couldn't even own it outside of the country. You just were barred legally from owning it. Now, a lot of people still owned it. It's hard to enforce, but it was illegal from the mid 30s to the mid 70s for Americans to own gold, and that was the exact period where people would want that release valve, where the fiat money was not holding its value, was devaluing. So debts were, even though debts didn't really decrease nominally that much, they were reduced as a percentage of GDP, partially from growth and partially from inflation. And so Bitcoin, so gold is still to some extent one of those off ramps people can use, and Bitcoin is a more accessible way to do that, in a more efficient way that people can quickly opt in and out of a system. And so I bring up Rao because you brought up Rao earlier. He's pointing out that that's been happening to some extent in Turkey, for example, where they've had some currency challenges recently, and Bitcoin represents one of the ways that they can pull capital out and then put it back in, and pull it out, pull it back in, as a way of preserving wealth. And so I think that's to have that system so easily accessible, kind of worldwide is it definitely changes the game, right? Because if people have that quicker release valve, it definitely changes how fiats have to operate if they want not to have a ton of exodus that way.
Yeah. All right, we're going to slide in one last question here before we head out. So next week, we're going to have Eric Townsend on the show. He'll be along with our co-founder, Jan Pritzker, and he'll be talking about CBDCs or central bank digital currencies and Bitcoin. And Eric is a fan of Bitcoin. He wants Bitcoin to work as a libertarian and to empower people, as we've been talking about here. But he's of the opinion that central bank digital currency, like the Fed coin, or as he calls it, the Orwell, will, be mandated essentially upon the world, or at least this country, and have all the opposite properties of Bitcoin. So, Nick, what are your thoughts on the prospect of CBDCs and the prospect of an Orwell coin developing and kind of making Bitcoin impotent?
I think I certainly think that that's likely. Actually, the first part of that statement, not Bitcoin being impotent. I think it's likely that we do get a CBDC, effectively a digital representation of cash in this country. I'm not optimistic that that would have the same privacy or autonomy characteristics that physical cash gives you. My reasoning for that is that physical cash has been systematically devalued in terms of what you can do with it by US jurisprudence over the last 40 years, effectively, with the Bank Secrecy Act and some Supreme Court cases, including the installation of the third party doctrine, that means that effectively you have no transactional privacy in the US, and also cash transactions need to be reported at a lower and lower real threshold. So the scope of things you can do with physical cash in this country keeps getting smaller and smaller. And my guess is that that's unlikely to change anytime soon. And in effect, if we do get a digital form of cash that represents Federal Reserve dollars, there's going to be very limited privacy, unfortunately. All the discourse I've seen treats privacy as kind of an implementation detail rather than sort of a core value that the system would enshrine. Now, where I would disagree with Eric would be in the allegation that because we're going to get some sort of panopticon coin, which is government administered, that means there's no scope for Bitcoin. I would say that is an enormous argument in favor of the existence of Bitcoin, that you would have something which is state independent. I'm not optimistic that everybody's transactional usage and privacy. First of all, I think it would be unconstitutional to have such an enormous invasion of privacy. And I think the fact that the US has to a certain degree embraced Bitcoin already is a really great sign. So I don't think the US is destined to go down this totalitarian path of kind of financial surveillance the same way China has so far. My guess is that there'll always be space for Bitcoin. But if it does, Bitcoin is going to demand for Bitcoin will be even greater because the alternative would be much worse. I think to the extent that there is some sort of CBDC which lacks privacy qualities, there will be a countervailing demand for Bitcoin as something which gives you much greater autonomy and potentially privacy.
I agree. I think again, the first part of that, I think that treasuries and central banks around the world, over time will probably adopt some of these technologies, for better or worse. In some ways it makes things more efficient. It makes, tax fraud harder to do, things like that, but then it violates privacy. Another thing that they want to be able to do with it, for example, is do more targeted stimulus. So for example, they can hand out those types of kind of controlled coins, and then they can have them so that they're programmed to be only usable in a certain jurisdiction, or only usable in a certain time period, or only usable on certain types. So that kind of technology gives them greater control, which of course can take very dark roots, especially if you look at China and their social credit score and the kind of the degree that they're willing to go to take away freedoms. But even in the U.S., considering what's constitutional, the fact that the United States banned gold for over 40 years, they just kind of looked at property rights and went, it's not convenient. So the thing about Bitcoin is that it's much harder to enforce that. So it was already actually very hard to enforce that on gold. So, very few prosecutions or legal issues happened around people owning gold. So it was a very hard to enforce and not heavily enforced law, even though it was illegal and punishable by pretty severe consequences. So with Bitcoin, it's you can't raid someone's house and get it unless they just have their their private wallet sitting there, and so there's more ways to protect it. It's harder to prove someone has it, and it's a more internationally portable thing. And we've already seen that governments, most governments, including the U.S., have gone in the direction of accepting it more and more. So now that we see more institutional, interest in the asset class, it kind of gets less likely every day that the government try to ban it, because as you get bigger and bigger, it becomes messier and messier to try to ban that. And we've already seen periods of civil unrest, right? So imagine if there's a currency issue, it's kind of like the period where they'd want to ban Bitcoin is kind of like, so when they banned gold in the U.S., the next thing they did was almost cut the dollar's value in half compared to gold, right? So actually the best thing you want to do is somehow, if you could, own gold. So with Bitcoin, it's like if they ever get to the point where they try to outright ban property, that means likely something is not going well with the currency, right? So you're likely to see kind of pushback against that, or again, it's a hard to enforce thing, and it's almost like that's exactly the sort of asset that people would want to own. Of course, I would never publicly say anyone should violate the law or anything, but it's just looking at the history of how those laws are difficult to enforce. It just kind of, it's not a very elegant solution on the behalf of government to try to ban those sorts of things.
Yeah, well said, well said. All right, thank you guys so much for joining us today. Really appreciate your time. It was a lot of fun. We'll wrap it up real quick. Remember, you can sign up for daily buys at swanbitcoin.com/dailybuys. We have Eric Townsend and Jan Pritzker on next week. That'll be a great show. Tune in. We also have Raul Powell and Vijay Boyapati on the slate for later in September, already confirmed. That's going to be a great show. So subscribe to the YouTube channel now at youtube.com/swansignal. Turn on those notifications. And if you like the audio, you can find the podcast at swansignalpodcast.com. Thank you, Nick. Thank you, Lyn. Really appreciate your time.